Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome back, everybody. It's baseball playoff time, so no perfect guest to have on with someone who, by the way, I can't believe has never been on the show before. Today's guest is Eddy Elfenbein, one of the OG financial bloggers. This is, I think it's 20-year anniversary from starting the blog at Crossing Wall Street. Eddy also runs the CWS ETF, which is from his annual buy list of 25 stocks. Eddy, welcome to the show.
Thanks for having me.
Feels like just yesterday we were sitting down having a beer in Washington, D.C. Where do we find you? You still in the Capitol?
I'm still in Washington, D.C. I'm with all the unemployed people.
There we go. Why did you start blogging, by the way, in 2005? What's the origin story?
This was around the time of the war in Iraq, and there were a lot of people who were political bloggers, and that sort of was that time that you could have feedback. Not everything was dominated by the media. And within that, I saw the emerging field of financial blogging. And the first person I really read was Barry Ritholtz. And here's a guy who, is not working for the New York Times or the Wall Street Journal, but a guy who's funny and he writes with passion and was just a great person to read because he was talking about real estate and he was talking about things that people were not talking about. And it was a lot of fun. And I said, well, I can give this a try. And it was pretty easy to start up. So I got it going, I guess, in mid-2005. So it's now over 20 years. In fact, I remember in September or October, Barron's featured two of these bloggers in an article. One was me and the other was Joe Weisenthal. And so that was the first time I was in Barron's. And I thought that was really neat because I was just wearing bunny slippers in my place, giving my thoughts about the market. And then I found out what people were actually reading it. So it was a neat time.
It's funny. I go back every couple years and look at, so for the listeners, most bloggers used to have a blog roll, and that was just a list of a bunch of other blogs that you might like or read or link to. And you go back and look, and there's a lot of nostalgia for some of those names, many of which most, I would say, probably have gone the way of the dodo bird, the sites, and people don't write anymore or move on to different things. But there's a few that are enduring, like yourself and others. Joe's now spends most of his time at Bloomberg, but it's the stalwart, as he is known. Anyway, so you started, writing, and we'll get into some of the topics today you've been writing about over the years. But when I think of you as a stock guy. And when it always comes to mind is your buy list. Tell the listeners what this is, what was the inspiration to get it started, all that good stuff.
Well, one of the things I wanted to convey to investors with my blog is that investing is not that hard. It's easier than it looks as long as you are patient and disciplined. So I said, I'll start a buy list. I actually first did it in 2005, just sort of to the end of the year. So it was a couple of months. And I said, here are 20 stocks. I won't make any changes. Just assume this is an equally weighted portfolio, and we'll hold it for one entire year and see how well it does. And we had some very good returns. And I did that for a couple of years. It's now 20 years, still going strong. And people said to me, I love your buy list. Is there a way I can invest in that? And I said, no. I mean, they asked, is there a hedge fund or something like that? And my answer was always no. And then I started talking to people on Wall Street and saying, is there a potential product here? And I looked all around and people were very polite, but they said no. And then I finally found one person, someone I know, Noah Hammond, and he had Advisor Shares. And he said, yeah, I think there's a product here. And we just had our 9th birthday. And as you know, in ETF years, 9 years is I don't know, 140. It's we're now, I think hundreds of ETFs close up shop every year, but I'm happy to say we're going strong, and it's around 200 million, which for an ETF is pretty small, but for an independent ETF is a very respectable number.
This is I think a key part of the fun part of the story today is that a lot of people fantasize about what you've accomplished, which is this idea of, hey, I mean, you're pretty much a one-man shop, where you're saying, look, I want to launch this and raise hundreds of millions of dollars. And yet you did it. And here you are, you got a 4-star fund. It's about to hit a 10-year track coming up soon. Sky's the limit. Every time I saw your ticker, I didn't think of crossing Wall Street. I thought of College World Series, which is the only of the main 4 sports, I think the only college or pro one, the finals I haven't been to. So Omaha, I'm waiting on Virginia to get back. I'll be there. Congrats. It's been fun to watch. So talk to us a little bit about the buy list / what you're trying to achieve here. What are you looking for? Are you just buying the Mag 7 and calling it a day? How do you dig around? What's your process? What's your framework?
I just look for high quality stocks. I mean, companies that I know are sort of going to be around, just very well run companies, sort of the blue blazer of a gentleman's portfolio or a Harris Tweed. This is always going to be a top notch, high quality company, strong market position, consistent earnings history, sales, earnings, dividends. Love to see that company with just a very strong position within their markets. And then within that, I look for the best price I can get. And, companies I know they're going to be around in 5 or 7, 10 years. And because our turnover is so low, a lot of our companies have been around that long.
So it sounds a little Buffety, but I mean, that's a compliment. What's your sort of universe? Are you tracking thousands of stocks, or do you kind of have your wheelhouse of, hey, these are my 100 or these are my 200 that I look at? How do you whittle that down?
That's exactly it. I have my watch list, which I have to criticize myself because I let it grow too large. Ideally, it should be around 80 names. And I find I'm always adding to it and deleting and adding delete, and it'll get up to 120, 130 names. But these are companies that I'm basically familiar with. I may know all the details. And these are what I would call very good companies. It's sort of, to keep with baseball, it's kind of the minor leagues. To get in there, I've had to have looked at it and said, okay, this is a good company. This is something worth following. I generally don't know it as well as the companies on the buy list. And then as we get to the end of the year, I give it a very, very close look. And what I do is at the end of each year, 5 new stocks are added from the watch list, and 5 of the stocks in the buy list will get kicked off. So it has a 20% turnover.
Which is cool and unique. I think a lot of listeners, one of the biggest struggles for all of us is temptation and wanting to trade more than we probably could or should. But this is somewhat of a unique kind of fixed criteria. It reminds me of Buffett's punch card. He's like, look, you only got so many punches. You get these, think about investing that way. And yours is like, look, I get 5 punches each year and in and out. And it's kind of like a consistent culling, 20% sort of situation. And so have you ever gotten to years where you're like, oh no, man, I really want to kick out like 8. He's like, these 3.
It always happens. And in probably most of the circumstances, the rules are to my long-term benefit and fighting against my emotions, because so many times like, oh, I got to get rid of this dud. And then it will rebound or another stock that's going strong, which I just think is absolutely terrific. And it will turn around and head south. So, and also I would say my predictions for the overall market are not very good at all. And fortunately, that doesn't really play in to our returns.
Right. Well, you had some recent posts that were fun. I actually like reading your kind of macro-y pieces because, I think it's some interesting perspective. A lot of people are talking about valuations and we just keep climbing. And you said a bubble is a bull market in which you don't have a position, which I thought was such a great quote. And it's kind of a riff on, Peter Lynch talking, it's kind of the opposite, which is, far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. And so you're like, look, I'm long and strong, come hell or high water. Let's talk a little bit about the actual names on the buy list, because long-term listeners know I am attracted to the weird ones. So the portfolio managers who, when you read their top 10 positions, you're not like, ugh, like again, we're like seeing these 10 hedge fund hotel names like that everyone owns. Yours, all right, I'm going to look at the top 10. I know like two.
Really?
I mean, you saying that's a lot or a little?
It's less than I thought.
I mean, look, I've heard of them, but if you were like, Meb, you need to describe the business model of IES Holdings. You need to describe the business model of Heiko, Syncora, Rollins, Inc. I know Intuit, on and on, but
Moody's, ICE, Abbott Labs.
okay. Well, so talk to us a little bit. How do you arrive at these? Because these are not the most followed names on the analyst buy list that I come across.
I follow them. I become fans of them. And I like stocks that are sort of just below the radar. It doesn't take long where you can know as much as anybody else on Wall Street. It's surprising that when you run across research, how shallow it really is. They're just rewriting press releases. So I love companies that are followed by only a few analysts, and even ideally if they're not followed by any analysts at all. I really like that kind of stock, and hopefully with fewer eyes watching, it's better to find a bargain. So a strong company, high quality company, and ideally one that nobody knows about.
Pick one out. Like, and this reminds me, it's kind of a fun, really old podcast we did on the Birken Road, which was a Professor Ritucci, who is from, I think, Louisiana. And the students were supposed to track and follow only companies that were kind of in the region. And so invariably, you come across these widget makers, whatever they do, that literally like no one in New York City has ever been to that town or ever. So does this naturally push you into small cap, mid cap, or do they sometimes end up being large cap? Like what do these names tend to fall in?
I'll go anywhere, but I would say the portfolio as a whole usually has a mid cap. I think that's where Morningstar has us. And it's just sort of, there's a sweet spot of about 15 million to 70 million. I'll give you a good example. I don't know if you've ever heard of Heiko, Heico. The ticker symbol is HEI.
Didn't the CEO just pass away, or the founder? Someone.
That's exactly right. He wasn't literally the founder, but he was sort of the guiding light for like the last 40 years. He and his sons ran the company. Since 1995, it's up 1,000-fold. And I think maybe 3 analysts follow it, something like that.
What do they do? Make umbrellas?
Yeah, they make replacement parts for the aircraft industry. And, if you are an airline, you got to keep those planes up in the air. And if there's something broken, it's much easier to fix it than to get a new one. So you're doing everything you can to keep those planes up in the air. And if something breaks, you really can't head to Sears and get a replacement part, but you can go to Heiko and they can get that for you. They also do a nice business with the U.S. military, which is always a good client to have. And they also do, aerospace kinds of things, but it's a company nobody really knows about. And the newsletter I wrote, I put in the chart, and it's 30 years. It's up 100,000%.
One of my favorite things, Apollo's been doing this lately. We've been sending out to the Idea Farm, but it's kind of like the comparison charts where you'll take whatever the hot stock of the day is, NVIDIA, Google, and then you'll compare it to some like the most boring stock and over a certain time frame. Like the famous one is Domino's versus Google, because they both IPO'd around the same time, and Domino's crushes Google. There's another one where we'll do Dillard's against NVIDIA. And obviously it depends on the time frame. But you're like, Dillard's, oh my God, I haven't been in Dillard's in 20 years. They still exist. And sure enough, the stock over certain time frames have crushed. And so it's funny when you see these names like Heiko, particularly names that like literally no one knows about. And yet over time, they are these just magic compounders.
Do you know Lancaster Colony?
No. I'm a quant, Eddie. I see the symbols and I'm like, I could maybe get this symbol and the name right. But, rarely can I get much deeper. All right, talk to us about it.
Well, they make croutons. And look at a long-term chart. It's astounding. Another one is Nathan's Famous. And when I was in business school, they would always talk about
I know that one. That's hot dogs, baby. We had pretend Dodger dogs last night at home because we were watching the game. And then we do a variant where we make the Japa dog, which is like the Japanese hot dog with seaweed and all sorts of gross stuff, noodles you can put on it, wasabi. I know Nathan's. Talk to us about it. I didn't even know that's publicly traded.
Yeah, NATH. And they've been around for public for 30, 40 years. Actually, no, I think even more like 60 years. They have the best advertising on July 4th every year. So people have heard of it. And it's a hot dog stand. I don't know what else there is to say. It's very well run. And I think it's looked over the years, it's creamed the Buffett. It's creamed, so many outstanding companies over the years. So it's a little more volatile than is ideal.
What's so volatile about the hot dog business? That seems like to me, like that's like a utility. Like the people, I guess, eat more hot dogs when times are tough. I don't know. They get worried about all the veggie dogs, maybe.
Yeah, maybe, or maybe it's an ancillary price. It's the mustard that does it. I don't know.
But that's an interesting one. So is that one you guys currently hold?
I do not. I just think it's a fun one that a lot of people don't know is publicly traded. Tootsie Roll is another. A lot of people don't know about that, but it's been around for years and years. As I mentioned, Lancaster Colony, Heiko. One that is on the buy list is a tow truck company based in Tennessee called Miller Industries. Did very, very well last year.
Which if everyone hears, they just assume that's beer company.
Yeah, that's right. That's right. But no, they make the big kind of tow trucks. They have the big boom that goes way, way up in the air and pulls trucks. I've seen the videos on their website. It's pretty impressive. Not many companies can do quite what they do. And I'm probably, you say, did a company beat expectations? Well, there are no expectations because nobody follows it. And you get the 10K, you can know as much as anybody. Also, a lot of these companies, they're pretty simple. They don't have these crazy off-balance sheet things, and they don't do these mergers and acquisitions and big floating bonds, things like that. It's usually pretty straightforward and simple. It's a good business, and they do well.
It's kind of fun too on these type of situations is like, you could probably call the CEO.
Absolutely. Yeah, you can get the CFO.
They probably don't even have half of them investor relations. Like the investor relations, you're going to get connected. This used to be like one of the fun indicators people talk about is like you call late. So, it's 6, 7 p.m. And that's like everyone tries to call during the day. And I was like, you call late, chances are like who you're going to get? You're probably going to get the CEO because they're the ones working hard and working late. Or if you don't, it's a good contrary sign, right? Hey, this person's just golfing now. And so all they do, they just go around towing people.
You call somebody and say, I'd like to know about your business. Nobody does that. And so a lot of people, yeah, I'll be happy to talk to you. One of the discussions, I know I've talked with Josh Brown about this and other people, is the Buffett style of investing, is that replicable in 2025? The idea that in 1962, you could sit with your, green visor looking over things and finding some gross mispricing of some company, or they own some building that's worth far, and it's carried on the books at a ridiculous price. And that's what, Buffett and Munger could do. And is that replicable in a world where you can screen so many stocks? So I would say the answer is it's probably not replicable, but not 100% so. So there are these bizarre companies that you can find out, and you can find outstanding buys.
I think this harkens back, you mentioned the green visor, but to a time of you used to have more stock pickers. And then this last 15, 17 years, I feel like it's been a little harder. Part of that has simply been the large cap mega domination of everything. You mentioned you kind of drift a little bit towards mid cap. How do you feel, even though you're not kind of doing the broad, do you feel like there's a lot of opportunities? Are you finding it harder in 2025 versus, say, the past decade or so? How's the opportunity set look to you?
It's been pretty hard recently. I mean, just look at the equally weighted ETF against any, broad one, and it's lagging pretty hard. And the problem about the mega caps is that they sort of suck all the oxygen out of the room, and so that makes it much more difficult. And sometimes when you talk to people about your track record, you're really explaining this is a manifestation of what's going on in recent months. It's not that the companies are all horrible, but it's just a trend in valuations. I don't know if it will reverse anytime soon, but I really don't plan to change my style to meet that. It's just something you have to deal with. There are cycles. I think Michael Gay said, there are no geniuses, only cycles. And it's difficult to watch just the way they dominate everything, but it's really not going to change how I go about it.
What's been some of the big winners over the past decade? Is there a name that really sticks out as being one of your dear favorites since launch of the buy list?
Probably the biggest winner in recent years has been Moody's. It just plows ahead. It's not literally a monopoly, but it's very close to one. And they just do an excellent business. So that's what I've been very happy with. I also remember when I added it, I was so particular on getting a good price for it. Like, if it falls below, 94, then it's a buy, but I don't want to go if it's 96. And, and then it's hundreds of percents later, and you realize in retrospect, that really doesn't matter that much. But it's really the growth just makes up for any errors that you may have at the beginning.
What are you looking at that's on Eddy's Christmas wish list that you're like, if this thing only went down 50%, baby, I'm going to be rubbing my hands together and salivating at year end? Anything in particular?
I'm thinking about that right now, so I haven't really made any specific things. Like, absolutely, I always wait till Q4 to start the winnowing process. One company that was on the buy list was Trex, which we did very, very well with. And then we like it. They make the phony wood decks, which are actually quite impressive. And they look like wood. A lot of people say, oh no, they're cheesy looking. No, they've improved quite dramatically. And they cut the cost, and so it looks exactly like wood, but it's not wood. So the problem is it follows closely to the housing market. And we did extremely well with it before, then sold it, and it's gone down. So that's something I would love to add back, but again, it would have to come down, see where the price is.
As you were talking about cycles, I thought we'd spend a few moments talking about some of your deep truths. And this isn't like Jack Handy quotes. What were those called? The Saturday Night Live? The
Deep Thoughts, I think.
Deep Thoughts with Jack Handy. We'll do Deep Truths with Eddy. And this one reminded me, and we can pick out some that you like too, but I'll start with some I liked because we like poking the bear a little bit. But this reminded me of Guyad's comment about cycles. And you can actually cross out a few words in this quote and replace it with just about anything. But you said, many gold bugs are quite simply fanatics. Explain.
What needs to be added? I used to, follow gold a lot and write about it a lot more. And I won't dismiss the category, but there's the level of discussion around gold, I think, approaches some fanaticism because they think, all of society is going to absolutely collapse. There's one saying, it's like, you should have like 5% of your portfolio in gold. It's a nice diversifier. That's one thing. But there are people who believe that the entire system is about to collapse and the only reasonable thing to do is to buy gold. Now, some of that, I think crypto has probably taken some of the fire from that argument. I even wrote a model on gold a number of years ago. So I got into that space and I tried not to stay too long because there's just a level of fanaticism about it.
You know what there's not a level of fanaticism about is tow truck companies or 5 or 6 of the other companies, fake wood deck companies. You don't see it go meme stock on those, maybe. That's what you need to do. You need to get on Reddit, Eddy, and start talking about But that's the great part. Like these pure American businesses where they have, a pretty darn good business. Those can be some of the big money makers. But I think what you said is key to everything we do, which is it's hard for people because they want to identify with their tribe. It could be Bitcoin, it could be gold bug, it could be whatever it may be. And without the knowledge that for every asset or style, there's a season, it gets people in a lot of trouble. All right. I'm going to do a few more. A high PE ratio is a much better sign of a stock to sell than a low PE ratio is a sign to buy. I think that flies in the face of conventional wisdom. Let's hear it.
A lot of times the low P ratio can be for a very good reason. And that's probably on balance more prevalent than a stock with an elevated PE ratio.
Here's a couple deep ones. What do you mean there's no such thing as a healthy correction?
Oh boy, that's one that always gets me. Whenever there's a pullback, they say it's a healthy correction. What does that mean? That it's helping them in the long run, but they're personifying the market. They're anthropomorphizing the stock market. The stock market does not work like that. It's not helped by, if you were running a 10K, you need to sit down for a moment. That could actually help your time. That's not how it works with the stock market. I remember Larry Kudlow always say, this is a healthy correction. It's meaningless. Like the idea that it's going to gather its wind, that's not how the stock market works. It's just a silly phrase.
Why wouldn't people say that 2008 and 9 was a healthy correction, a healthy bear market?
Because it lost 50%. At what point are we better now?
If you're a stock investor and you're investing in all these future cash flows, that should be great. It should be, in their mind, a super healthy correction is what that should be.
The idea that it's embedded in the correction is what makes it better for the long run. I don't get that at all. It's one of these nonsense phrases that you hear a lot.
Well, there's a lot of those. Another one, when you hop over to the bond market, you say, the media never questions the bond market. Only stock investors are greedy. What does that mean?
The bond market is always assumed to be correct, but the stock market is always, and it's dangerous. It's one of these things. Stock market's dangerous. It's not dangerous, but the bond market, nobody always says, oh, there's some crazy bubble going on among bond investors. It has this reputation as being much more cerebral and refined, where stocks are considered a bit shady, especially if there's a bull market. And I'm speaking of the media broadly.
Well, the media, but also individuals and pros. I mean, the amount of misunderstanding when it comes to bonds, we consistently do our polls and we ask people, particularly after inflation, how much do you think T-bills or 10-year or 30-year have declined at some point? And most of the time, people are like, nothing, 10%.
Yeah.
And you're like, bro, these declined 50%. I mean, if I'm pulling up the TLT currently is still down from the peak 38%. I was like, bro, if we had stocks down 38%, people would be losing their mind. They'd be going crazy. And I'm like, the 30-year, this is 20-year, 10-year is still down 10%. And that's nominal. So tack on 7 years of inflation on that too. And it's even worse. But people always say stuff like, well, yeah, but with a bond, I'm going to get my money back or something. Or you're like, well, but that money's not going to be worth half of what it was worth 10 years. Anyway, that's a good one. But I don't think people understand it, honestly.
Tell them just the 1970s. Go look at it.
Yeah, I like this one. I'm not sure what this means, but it's Halloween time. So you're talking about scary. The market is self-aware. Scary, but true. What does that mean? Aware of what?
Of itself. So this is one of the problems about finance as a science, is that finance has physics envy. It seems that the stock market is like a test tube or, a chemistry thing. And the market does not work exactly that way. The market can go up because it's been going up. The market can go down because it's going down. Because we're watching it, the stock market moves based on that we're watching it. Where in a physical sciences, if you're looking at whatever element in a lab, it doesn't care about it being looked at. But in the stock market, it does. Does that make sense?
Makes sense to me. May not make sense to the listeners. I don't know. But yeah, I mean, it's interesting as you kind of go through the philosophy, the happy hour debates about market efficiency, what's going on in the world. It's an endless puzzle, that's for sure.
Have you ever heard this story or something like this, that a person has an art gallery and they have a painting that just won't sell and it's just there forever and ever and ever? So they double the price and it sells the next day. Have you ever heard stories at least like that? And I think most people, they understand that it's plausible that something like that can happen. And the idea that price is a factor in the decision. And the stock market is like that as well. These are not independent, that you have the price over here and the value over here. The value can be impacted by the price itself.
I think former podcast guest Whitney Baker would describe those as Geffen goods, where people get more interested the higher the price goes. And there's so many examples of this, which is interesting because you feel like the brain, for particularly the pros, would be trained a little bit in the opposite. It's hard to fight against that. But you also kind of just described the business model of the entire hedge fund industry, where, hey, we're going to charge you 2 and 20. And people are seduced to that business model because they think that's where most brilliant people are going to be. Anyway, it's a curious situation.
I was just going to say, didn't Renaissance even charge much higher than that? But the idea is, look, if you want the best, this is what you have to pay. It's a great mindset to do that.
I feel the problem with the Renaissance is that's the one example out of 20,000 that actually is valid. And to be clear, it's the fund that no one can invest in. So most of their forward-facing institutional funds are fine, but they're nothing to shake a stick at. It's the one that no one can invest in. It's capacity constrained. That's interesting. Here's a good one. The Grand Elfenbein theory to explain the entire stock market. We need like another hour for that. What does that mean?
I got to say, I'm not 100% on that. So it's a much mushier idea. The idea is that at some point, when a company gets large enough, a stock gets large enough, it boils down to about one of 7 or 8 buckets, being a value stock, an income stock, a growth stock, a defensive stocks. And the company has to be large enough to fit into one of those buckets. And there's I think, a connection of those groups to the bond market, how the bond market moves. So when short-term rates go up or down, there are certain stocks that beat the market and fall short of the market. Also, when long-term interest rates go up or down, there are stocks that beat the market or fall short of the market. Now, if you're looking at that, you'll notice that we can bring those two ideas together, and there will be the yield curve gets wider, and some stocks do well, some stocks do not do well, and then the yield curve gets narrower. Again, we'll see that same thing work itself out. Am I babbling? Does this make any sense?
No, this is great.
I think there's a connection between the relative return of markets and the yield curve.
First of all, 100% agree with you. We looked at some of these ideas on a macro basis, not just on the stock market. And this is one that kind of makes intuitive sense. I feel like it's easy for people to grasp when you look back at macro. So, for example, if you look at a really steep yield curve and say something generic, 10-year minus 2-year, 90-day or something like that, not surprisingly, the assets that do the best going forward are sort of the spread assets where high yield benefits. So things like REITs or 30-year bonds. Stocks do great kind of in the middle. And then when it's kind of an inverted yield curve, not surprisingly, cash, but also gold. So here we are with gold. By the time this publishes, who knows, we may be over 4,000. My goodness. It's really been a shiny investment that for many years was just left to the trash bin.
I just want to add some quickly on top of that. Like we've seen in about the last 6 months, very poor performance from healthcare, relative performance, and staples. And I think that's a good example of it's a bet on the economy. You would think that these defensive areas would do better if the economy is doing poorly. And now they're doing poorly. So is the economy going to do better? And that is something I think that lower interest rates could upset that could start that rotation. I'm not confident to say it will just yet, but that's the kind of dynamics that I watch closely within the market.
How do you handle, let's say it rolls down to the end of 2025 and healthcare has just been eviscerated and you're like, oh man, this is like candy store. I see like 20 stocks I would love to buy. How do you deal with sort of a concentration and balance? Do you have a max number that can be in any one sector, or can you just YOLO all 20, well, I guess it's only 5 per year, but could you theoretically add 5 healthcare stocks?
Yep, absolutely.
Have you ever?
No, I have not.
Yeah.
In fact, healthcare or medical devices is a sector. It's just sort of tailor-made for what the kinds of stocks I look for. So many excellent companies. I've, Stryker, and I had Medtronic for years. Love looking at those companies. It's tied closely to the government, strongly supported by government revenues, very consistent operating histories. Their earnings don't float around a whole lot. So I'd love to look at a lot of those companies. Some can be very expensive is the problem. But yeah, if I saw adding, say 3 healthcare stocks and 2 staples, I would do it if I think it's a good price. The difference is I'd be holding it for at least 1 year and on average for 5 years. So that's, also plays into.
How many, if any, do you got any names that have been in there for the full near decade at this point?
Pfizer has been, not Pfizer, the drug company, but Pfizer. I recently got rid of Aflac, so for this past year, but they were in since the beginning. So it was, 19 years.
Wow. Were you a little sad?
I was, yeah. It was a, tear came down. Moody's and ICE has been there for a long time. They just become like, regular parts of the portfolio.
It's like family members at that point.
Exactly.
Any stocks in your anti-portfolio you look back on? Stuff that you didn't buy that you're still sad about?
The big one is Eli Lilly. And it's especially bad because I had my most dedicated reader, my mother, bought Eli Lilly, and she didn't sell. So she did very, very well with that. And so I'm one of the few portfolio managers. I don't think Warren Buffett gets text from his mother on a big day for one of his stocks. And then I say, Mom, how many shares do you own? And she'll say 11 or something like that. But she loves to follow that. But Eli Lilly, I stupidly sold, and I had it. I owned it. I was there. I was in the right place, and I missed out on a huge profit run.
You say this just got too expensive or what?
I don't even recall what it was. I tried to blot that out.
I saw my buddy, Steve Sugarud, give a talk on this, and he was like, this is before it really hit mainstream. And he's like, look, there's this class of drugs. I experimented. I took one. I lost like 50 pounds. This has potential to revolutionize. But discretionarily, I'm like a cheap bastard contrarian. So I look at the chart and I'm like, I missed it. I can't buy this after it's gone up this much. And then sure enough, that was, I don't even know how many baggers ago that was, 5, 10, whatever it was. But that's a good one too. What's been your most memorable investment? Is there one that sticks out?
Yes, there was a tiny company called Nicholas Financial, and they did auto loans, and which you could be a pretty profitable business. Nobody followed them, tiny little company. And during the financial crisis, people assumed that this was a subprime company and assumed that it was just like all the others. And it wasn't at all. In fact, they held their loans until maturity. They didn't just sell them off immediately. And I mean, they ran into difficulty, but they literally got to about 20 cents on the dollar. And it was just so obvious that this company, people thought it was about to go bankrupt. And it was absolutely no threat of that whatsoever. And I swooped in, bought a bunch of shares, and made a nice return on that.
Where'd you learn your market chops, Eddie? Were you just reading Buffett annual letters? What was the scent?
I started with that. I started, just read everything I could. Peter Lynch, always a big fan of what he had. So I did that. Went to business school. I don't know how much that helps, but I was just always, and I remember at business school, there was sort of a group of us who got together. We just talked stocks all the time and what kind of things to look for, what we liked. I was in actually the newsletter business for a couple of years, so I got to know some investors, some major investors. Learned a lot from them. So I was always reading, experimenting, and doing my own investing. And I can tell you, I've made a huge number of mistakes. So
Yeah.
when people talk about the mistakes, I can tell you from experience, I've made almost all of them.
For the people listening who hear this story, they're inspired, they're like, all right, I want to go launch an ETF. As you think about kind of the agony and ecstasy of doing this professionally, any things you look back, any thoughts you tell some young whippersnapper that wants to do one, any suggestions for them?
It's a difficult thing because there's a central contradiction that you need a track record to draw assets, and you need a track record. They're not going to invest in you until you can prove it. So getting over that hump is very difficult. So I would say to anybody looking to do that, you really want to concentrate on what you can bring, what is different about your product, and something that you know more than anybody. The ETF, until you get to around 25, 30 million, is a very difficult business to be in. It gets much better once you get over the hump, but so much of it is getting over that hump. And you can have a difficult year. Everything can go right for you. You can be well set up, and the market can turn against you. So it's a very difficult business.
And turn against you, not just, I think everyone, the biggest assumption that when we talk to people, first of all, we always tell people you should absolutely do it. Go launch an ETF. But I often say, look, there's kind of two main considerations. One is you got to be willing. So unless you have seed, and break even seed, depending on your fees, could be anywhere from 20 to 80 million. It could be a lot, depending on just kind of what you plan on spending and what your fees are, et cetera, et cetera. But we often tell people, say, look, a lot of people have zero. And so they just assume they're going to show up and there's going to be this pot of gold and money is going to rain down on them. And that's by far the hardest way. And it's even harder in sort of this day and age of just thousands and thousands and thousands of funds. And so then I say, look, you can still do it, but you got to be willing to subsidize it, and not for like a year or two. I usually tell people, like, to really feel comfortable, it needs to be like 10, but at least give it like 5, because you don't know what the hell the market's going to do. It could be anyone's guess what's going to happen. So I think most people, and particularly all my friends that have closed funds, the problem is usually they do it a year later, they're at like 5 million, and they're like, I really don't want to be paying for this. And you're like, well, like, you kind of should have thought about that ahead of time. With all that having been said, go do it.
I had to write some big checks for a long time, and nobody ever sort of talks about that. They'll say, your fees are so high, or, how well did you do last quarter? You were up, but you didn't beat the market. Another thing, and I'm curious if you may have similar sentiments, is that I viewed myself as a stock picker. So I love sort of digging into the numbers and reading, the reports. And some of that time is taken up that you have to raise money. And so you have to do things and talk to people and talk to investors. So you viewed yourself, what you thought was this role, but you really have to do multiple roles. Not that I don't enjoy that, but it's just something, if you are serious about your fund and you want it to be a thriving product for the long term, you got to consider that as well.
This is close to home because yesterday we have what I call is my least favorite day of each quarter. It's not as bad as it used to be, but in the early days, it was particularly painful, which is known as our board meeting. And so you have listeners, like 40 people on a Zoom, talking about tracking error and compliance and regulatory updates and all sorts of things that really, it's things that can go wrong and have gone wrong. We always tell people managing money and the business of managing money are two totally different skill sets and day jobs. And managing money is the sexy part. Everyone sees billions and they say, oh man, this looks fun. I'm going to make a ton of money. And then they're like, no, you got to talk to 200 investors to get one. And then once you get one, of the sum you get, they're invariably certain ones are going to call you and tell you how much of an idiot you are and why you lost them so much money. And they should have just put all their money in the Qs or NVIDIA, on and on. Anyway, it's all fun. You guys should do one. Promise.
Everybody do one.
Yeah. What's on your mind? So as we wind down 2025, as we look out into the future, what's got you excited? What's got you worried? Anything you're thinking about, reading, on and on?
I'm in Washington, D.C., so the big thing right now is the government is shut down, and who knows how long this can be. But one thing is that we're going to not get a lot of the economic reports that we usually get. The jobs report will come out this Friday, is when Meb and I are talking. I don't know if that's going to come out. Now, the Fed is independently financed, so it can still run. There are some reports coming out. So we're going to be flying blind for a while in the markets. And then also a lot of people in DC, maybe not just furloughed, but fired. And that could have an impact on consumer spending. Just to circle back, the big thing that sort of I've been watching on is the substantial outperformance of high beta versus low vol. Obviously, that's a cycle, but it's gotten to pretty extreme levels, I think. And given with the market, it looks like we're going to have a closed government, and there's a good chance we'll be at an all-time high today. So at some point, I think we're going to be ripe for a rotation. That's sort of dominating a lot of my thoughts. I don't know when it's going to be. I would never predict that, but at some point, I think it's got to give.
There's a great download from our podcast alum friend Pim at Robeco, who has a series Excel academic papers too. We'll put it in the show note links, listeners. They do a bunch of low vol strategies and ideas, and he takes it back. I think you can download it to the 1800s. And it's really fun because you can walk through, and it's a good example of financial theory that for a long time people were like beta and the type of ideas where actually the low vol outperforms over time, which is not just flies in the face of financial theory, but it's literally the exact opposite.
It's the exact opposite, yeah.
But the interesting part is that traditionally it doesn't really keep up during the romping, stomping bull markets. But when does it make hay? Usually when the S&P is going sideways or down, particularly in the bear markets. So we've had a cycle. Some small part of me, Eddie, hopes we take out the 99 highs on the Shiller Cape ratio just so I can say we did it. We're at around 40 currently, and I think the peak was 44.
I've been surprised that it's not designed specifically for that, but the Cape ratio has been not a bad market timer if you use it for that. I've been surprised by how well it stands up.
Well, it's interesting globally too, and we talk a lot about this, but if you go back in times in the history where stock markets Cape ratios have been above 40 and then walk forward 10 years, it's, again, I think the average returns are zero on a real basis. So not good. Again, not minus 20, like it's not guaranteed to have a Great Depression or something. They can just be not as good as the 15% we've seen per year for the past 15. I mean, that's front and center, DC. Who knows? Maybe the bull market accelerant. All of a sudden, the government shut down and it's a good thing.
Yeah.
Hopefully, we just get a little quiet, a little less news. Everyone's just going to go get on their AI and Sora and play around on all the other distractions. Eddie, where's the best place people to follow you? They want to read your blog. They want to buy the CWS ETF. Where do people follow you? See, when does the list update, by the way? Is that post 26?
Right around Christmas time.
Christmas time.
Yeah.
Do you have some names in mind already, by the way?
Yes, but I can't tell you.
Ooh, exciting. Do you do that? You should do like a great reveal party where you kind of like, you pull out one ticker out of the hat, pull out the next ticker.
A gender reveal, which is...
Yeah. We talked about doing that for one of our fund ideas. All right. So where do people find you? They want to go to the blog. What's the best spot?
Well, the Crossing Wall Street is the blog, and I have a Substack, CWS at substack.com. And I do 2 newsletters each week. One is a paid, one is free. the page goes into sort of a little more details about the stocks on the buy list and sort of dissecting them. And then, of course, I have the ETF, which you can look up at the Advisor Shares website or just put in CWS ETF and it'll come up.
Eddy, it's been a blast. Thanks so much for joining us today.
Thanks for having me. This was fun.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.